If you've been studying ICT, learning fair value gaps, learning order blocks, or even trying to trade market structure, and you're still wondering why month after month, week after week, you still can't get funded or even make a withdrawal, it's probably because you're doing one of these things wrong. I don't want you to think that you're broken or you need to change strategy. It's just that you're missing a few key things. And when I was in that situation, going back to 2016, where I was always losing, I was struggling to get funded, and for some reason it just felt like the profits just kept going away from me, it was because I was lacking a true understanding of what was actually driving the market. So what we're going to do today is we're going to fill every single one of those gaps in your knowledge so that you're never making those mistakes that are holding you back from consistent profits. So with no further ado, let's get right into the video. Most ICT traders are not actually trading a strategy. What they've done is they've gone to YouTube, they've gone to different courses, and they've just got different pieces of concepts. For example, they hear about fair value gaps, they hear about order blocks, they hear about market structure. So when they go into the chart, they're just trying to pick out any order block. They're just trying to pick out any breaker structure. No wonder why you keep losing trades and you never have a consistent return. Because when you're trading, you need to have a strategy that is one, proven by data, and two, is not just random individual concepts. If you've memorized what a fair value gap is, if you've memorized what an order block is, or you know what a market structure shift is, that alone is not enough to actually make consistent profits because it lacks the full bigger picture and understanding of when to apply it and when not to apply it. So stop trying to use and piece together all these individual concepts and learn how to actually build a strategy behind it, which we are going to go through today. First thing you need to understand is that you're trying to trade fragments of a strategy and not the whole strategy itself. So no wonder why one day you're making money and the next week you're not. It's because you don't have a full strategy that is actually backed by data. You see, when you go into the markets, if you're just trying to find any order block or any piece of market structure shift or any zone and trying to buy and sell off it, you're not actually building a narrative and a storyline behind it because you don't have a full strategy. When we go to the markets, what we want to do is we want to act like a lawyer where we're actually collecting pieces of evidence to build a case on whether buyers or sellers are actually in control. And the first piece we can do to do that is to use a fundamental narrative. You see, when we talk about fundamentals, we're talking about the actual reason why the market is moving up or why the market's actually moving down. Because if you're just picking any old bullish order block, of course, it's never going to work if there's no fundamental reason for buyers to actually step in the market. So before you go to the charts, focus on actually building a fundamental narrative. Focus on understanding if one, buyers are actually in control of the market without even looking at the chart. You see, technical analysis is always responding to what the bigger players are doing. And when it comes to the bigger players, they're not just relying on squiggly lines because, these charts, they can be very ambiguous. But when you actually pay attention to the facts, the real core drivers of price, such as inflation data, such as the monetary policy, things that we'll go into a little bit more detail later, you truly understand why institutions are actually starting to accumulate and buy the market. So when you have that reason, you're not just going to get caught up in random sells because you know that there's no reason for sellers to actually show up and try to short the market. So before you even start trading, make sure you can build a fundamental understanding and understand the monetary policy of the actual instrument you're trading if it's a currency. If it's a stock market, hey, that's a little bit different. But when it comes to understanding fundamentals, for me, this is how I get market direction without even looking at a chart. So if we're trading different currencies or even the US stock market or risk assets such as crypto, the first thing we want to do is understand the monetary policy of that market. For example, what do we mean by monetary policy? It sounds a lot more complicated than it actually is. It just means if the central bank, because it's the central bank are the people who actually control the flow of the money. So if they're trying to slow down the economy and crash the stock market, they'll go through a process of something called, again, it sounds a bit more complicated than it actually is, but they use something called quantitative tightening, which means they're starting to raise rates because inflation's getting too hot to try to slow down the economy. So when you're seeing talks about rate hikes, higher rates for longer due to high inflation, what that will tend to do is actually crash the stock market. So if you're trying to buy these bullish order blocks or these accumulations, when inflation is going up and when interest rates are going up, that's never going to work out. The market will always start to sell off and crash. Vice versa. If you're seeing that interest rates are now coming down, you're seeing that inflation is now coming down, the markets, the stock market, for example, US 30, your NAS 100, your SPX, even your cryptos, Euro USD, GBP USD, etc., these will start to appreciate and go up. So if you're now trying to sell the market in a fundamentally bullish market, it's never going to play out because there's no reason for institutions to actually want to drop the market. In fact, what you'll find yourself doing is getting sucked into these smart money traps or these liquidity grabs where you're seeing, oh my God, this sell entry looks really good. You take the trade and what happens? Bang, you're hitting your stop loss. So before you go to the chart, actually build a narrative, actually build a case and understand who's in control and why they're in control. And once you have that bigger understanding, you're not going to be getting sucked into these fake sells or these fake buys because you understand the bigger picture and where the market's going for the next few weeks and next few months, because you've done that fundamental research and know where the market is actually going based on facts and not fiction. You're also treating these ICT concepts like a signal service, where as soon as you see an order block, as soon as you see a market structure shift, you're jumping in the market straight away. But you're not taking these concepts through an actual plan. You're not applying them in the correct way. You see, you can't just go to the market and pick a random imbalance. You can't just pick a random order block and expect it to play out. You need to know where that is. Because if, for example, you're trying to buy in premium, well, why would you want to buy something when it's expensive? You want to wait for the market to come back to a discount before you get in. So knowing where you actually are and why you're seeing these concepts form is important. For example, we've got those ICT traders like, oh my God, look at our order block, look at our buy to sell candle. So what do? You come in, you're trying to take your entry, put your stop above the high, and obviously then target some new lows. But if we're in a fundamentally bullish market, there's no reason for sellers to play out. So when it comes to context, make sure you're doing top-down analysis and you're going through the higher time frames and working your way down to a lower time frame. Because if we just zoom out for a second, well, what can we start to see? We can see that higher time frame, we're actually in this bullish leg. So even though we've seen this breaker structure, this order block, this fair value gap, because the higher time frame is bullish, these lower time frames are not going to work out trying to sell it because the higher time frame, the overall tide, is going one way and we're trying to go the opposite way. So just by seeing that this higher time frame has come into this reaccumulation where it's manipulated the lows, it's breaking to the upside, we know that we're looking to target this high. And the lower time frames need to be in alignment with this higher time frame. So if our higher time frame is bullish, the lower time frames need to be bullish following that. So now when we are going to these lower timeframes and seeing this breaker structure, distribution, manipulation, whatever it is, we know there's no reason for this to play out and it's just setting up as a trap. It's just getting ready to create a reaccumulation where it induces all these people to start selling before it breaks to the upside and hits all their stop loss and then continues back. Furthermore, what do we also know about GBP USD right now? From a fundamental reason, there's no reason for buyers to step in on the US dollar, because if buyers step in on the US dollar, that's going to mean GBP USD is going to go down. Well, what reasons? Well, what did we mention earlier? The inflation and the monetary policy. So if we look what happened yesterday, we can see that inflation yesterday did actually start to come lower. And if inflation's coming lower, there's no reason for the central bank to have high interest rates. When it comes to interest rates, think of it like a bank account. If you've got one account with a high interest rate and one account with a low interest rate, obviously you as an investor, you want to put your money where the better yield is, the better return on investment. So what's inflation got to do with that? Because when we understand that inflation's going lower, we now know that interest rates will tend to follow the path of inflation. Inflation's coming lower, interest rates will tend to go lower. So think about it. If you've got your money parked in a bank account and you know that return on investment is going to become lower and lower and lower, you've got to be pretty dumb to keep your money in there. You're going to take it out and put it where? Somewhere else you'd get a better return on investment. Start backtesting inflation data. Start backtesting what happens with monetary policy, because once you can start to understand this data and you combine that with your top-down analysis, you're going to stop getting sucked into these silly trades. Think of how many times sellers have tried to step in. How many times have we seen those breaker structures to the downside and it's reversed? How many times have we seen those order blocks and fair value gaps that have just constantly failed? It's because where we're seeing inflation come down and the central bank are now talking about cutting rates in 2025, there's no reason for institutions to want to sell GBP USD. In fact, they're starting to sell the dollar and buy in the British pound. That's why we're seeing GU continue higher. So when you are starting to trade these smart money concepts, whatever you want to trade, I want you to remember that it's all just the same thing, but you need to have the right approach to the market, because where you've got all these concepts in your head, you've watched all these YouTube videos, you've seen all these different mentors, you've brought all these different courses, one day you're going to the market and you're seeing these concepts. And then the next day you're going to the market, you're seeing all those concepts. So what happens is you start developing an inconsistent approach towards the markets. And because you've got that inconsistent approach to the markets, naturally the result you're going to get is going to be inconsistent coming from the markets. Every time I go to the market, and again, I've been a full-time trader now for the last 6 years, I do the same analysis every single time. The first thing I'm doing is looking at fundamentals. I'm understanding who's in control of the market. Is this market going to be going higher or lower based on investors wanting to accumulate this currency or distribute this currency? Well, like we said, if inflation is starting to go up, naturally interest rates will follow, and that will start to create more demand for that currency. Versus if, for example, inflation is starting to fall, which we're seeing with the US dollar, interest rates will tend to fall, so there's less demand for that currency, meaning it will start to go lower. If we open up the dollar without even looking at the chart now, we're trying to short this market. So now when we go to the chart, we have to apply the same analysis every single time. Don't change how you mark up the charts. If I'm looking at a 1 minute time frame, I'm looking at a weekly time frame, I apply the exact same concepts in the same order. The problem with you is one day you're looking at market structure, now you're looking at order blocks. Look, you need the same plan and the same step-by-step process every single time. So first thing I do when I go to the market is I look at my Wyckoff price cycles. Now, again, I have done more in-depth boot camps on Wyckoff if you do go on my channel and check it out, or it is something that we do teach highly in depth inside of the Master of Coin Mentorship program. If you do want my full trading plan alongside with one-to-one guidance and trade live with me 3 times a week, go down to the description, apply for the Master of Coin Mentorship, and I'll see you in the team. So for me, as a Wyckoff trader, again, what's Wyckoff? Wyckoff is essentially where ICT learned from. All these concepts he uses are just fragments of Wyckoff methodology. So what I'm looking for is these Wyckoff price cycles. And I can see that what we have over here is this Wyckoff redistribution, where the market comes down, manipulates these highs, followed by breaking to the downside. Now, of course, we do have a lot more in-depth principles to validate this like a science and make it more mechanical. However, I don't have enough time to go through all of that in today's video. Once I've got that, I now come in, measure my cause, not the effect, and I'm now looking for the price to mitigate these 50 and 80s. And if this was a 1 minute time frame, I'd be looking for the market to come in and create a new low relative to my leg. So even though this is a weekly and daily, I have a reason for sellers to show up, and then what am I now seeing in the market? I'm seeing bearish price action. Now, of course, it's on a weekly time frame and this will take longer to play out. Well, that's now where we keep doing our top-down analysis and applying the same plan in the same order on each time frame. So as price is now in supply, I would want to see proof of supply come in on a lower time frame, which would be a distribution. So if we drop down to a daily time frame, some of you might be saying, but Kieran, this is a bullish market structure. It's manipulated the lows and broke to the upside. Well, what reason do we have for buyers to come into the market? If interest rates are going to be coming down because inflation's coming down, and we've got a Republican president in the US, what reason is there for a bullish dollar right now? If you can think of one, let me know in the comments. But that's why I'm not concerned about this demand on the chart, because it's not actually demand, because there's no reason for buyers to actually want to come in the market. Now, if fundamentals did switch and we started seeing inflation go through the roof, we started seeing interest rates being hiked, of course, hey, look, I'm going to pause on the sells and I'm going to wait for 2 things. I'm either going to wait for this demand to be broken or the fundamentals to align. I need the technicals to align with the fundamental narrative. If there's a discrepancy, I'm not going to trade. Obviously, we know, right, after our UTAD of our distribution, we normally get that sign of weakness. So if I can now keep going down to a lower time frame and I can keep spotting this Wyckoff price cycle like I do every single time frame, I can start identifying the key zones to buy and sell from. So what can we see the market do? It started to create this type 4 distribution up here, where we have this like ascending wedge, followed by our new redistribution of price. So again, I do the same thing. I mark up my manipulation. And now I'd simply be waiting for price to come and mitigate this supply. Now, I can stop there, or I can continue depending if I want to start to swing trade or day trade. If I want to swing trade, hey, I can wait for this level. But if we look at the market, these highs were formed in January and it's now, April, so it could take a few months to come back. If you don't want to wait for that, you can apply the same thing where you'll see another bearish market cycle inside of this leg. So I'll drop down to a lower time frame and I'll look for the same thing. And what can we see? I can see the market be distributing. I can see the market redistribute. I can see it redistribute. I can see it do what? Redistribute again. So now I can come in, I can validate this redistribution. And once it matches these validation criteria, I can now fib up my cause. And now I'm getting to more recent price action. I can wait for the mitigation of this. But the key is having a repeatable process and doing the same thing every single time you go to the market. If one day you're trying to identify liquidity grabs and then fair value gap, listen, it's not going to work out. You need to have the same approach every single time. So from there, right, now I'd obviously be waiting for the market to come up, give me that lower time frame proof of supply. And if it happened at the right time of day, I'd be taking a sell out of that. Now, if I do want to scalp, I can do the same thing again, because again, this whole schematic here was formed at the start of April on the 3rd, and obviously now it's the 11th. So if you're willing to wait, because obviously we look at the time, this thing took about a week. If you're looking to wait another week for a trade, that's fine. You can stop your analysis here. But if you want to keep going because you want to day trade or scalp, you just do the same analysis again on a 1 minute time frame. So all I would do is look at the price cycle where we can see it distribute, redistribute, and you can see it's just redistributing and walking the market down. So what I'd be doing now is, again, because I've got this strategy, because I've got this model and because I've got these validation criteria, I'm only trading once all of the validation criteria is met. I'm not trading what I think is going to happen. I don't even trade what I see. I trade what I can validate and not what I think, because it has to be a repeatable process every time. Reason why you don't have consistent results is literally because your approach isn't consistent. But Kieran, I apply the same strategy every time. Well, have you actually had your charts reviewed by someone? Because when I started trading, I never had a mentor, I never had guidance at the start. Of course, I got one, but what was happening is I was going to the charts and I thought I was applying these concepts correctly. So I'd go to the market, I'd use the same approach every time. I'd look at the fundamentals, I'd look at the market structure, I'd look at the order blocks, I'd try and take a sell, but it would just never be consistent. I'd always find myself making some money and then giving it all back. And it was because I was unaware that I was actually applying it incorrectly. And that was because I never had anyone to guide me and review my charts. So make sure that you are getting your charts reviewed by someone who's got the exact results you want and trades the same way of you. Don't hop to different communities, don't hop to different strategies. Find one person, one strategy, and stick to that until you get it right. If every week, every month, you're joining different communities, joining different strategies, you're never going to be successful because you've got an inconsistent approach. And what do we know? Inconsistent approaches always lead to inconsistent results. So now what do we see here, right? We've got another potential redistribution forming, but it doesn't meet my criteria yet. I need to see it confirm the redistribution and then come and mitigate. And then if it can come up into here and give me my lower time frame confirmations, then yes, I'm going to take the trade. But Kieran, what if it loses? Well, again, this is where actually having an understanding of the market comes in. Let's say the market actually breaks this supply zone. Does that mean buyers are in control? Well, no, we already spoke about this. We said that there's no fundamental reason for buyers to come in the market right now, unless the lower time frame starts to break the market cycle and break structure. Doesn't mean that buyers are in control unless you've got the fundamental reason. In this example, there's no fundamental reason at the moment. So any sort of breaks of structure or breaks to the upside or bullish signals, I'd completely ignore, and I'd be anticipating it to simply bring us up to higher sell zones. Because again, if you have the option to sell, why sell something at, for example, £10 when you can sell it at £20, £30, £40 or £50? We always want to sell at more premium pricing. And this is why you can't get emotionally attached to your trades. Too many traders, right? The reason why they constantly fail and ICT strategies, Wyckoff, whatever it is, never works for them is because they're too emotionally involved. A lot of the time, it's your expectation of the trade that causes further problems down the line because you've seen your plan play out and you expect that because your plan presents itself, this trade should win. So what happens? You take the trade, you manage your risk 1%, 0.5%, whatever it is, you take the sell and it loses. And now you start getting annoyed. You're like, wait, what? Why did this trade lose? What happened? Maybe I did something wrong. Then you go and start tweaking your plan and changing your strategy. But this is why, again, it comes to having data on your system. Every trade I take, whether it's a win or a loss, is the same trade for the last 6+ years I've been full-time. Obviously learning before that as well. For me, when I see my entry criteria present itself, I don't expect that trade to win. I expect two things to happen. Either one, it hits my stop loss, or two, it hits my take profit. And now this is where you have to start to look at your beliefs. Because what do you believe hitting stop loss means? What do you believe hitting take profit means? Because for some of you, hitting stop loss means, oh, I did something wrong, I fucked up. Or hitting take profit means, yay, I did something right, I made money. What if that take profit is just one win out of 100 losses? For me, I look at my system in sample sizes, not just one trade. Over 20, 30, 40, 50, 100, 200, even 1,000 trades. And I don't expect that because my plan has presented itself, it should win. I understand that I have an edge. And an edge simply just means if you consistently apply the same thing, over time, you've got a higher chance of being right than wrong. It doesn't mean that on a trade-by-trade basis, the next trade must win. Maybe this trade can win, maybe that trade can lose. We don't know if the next trade will win or lose, and that's not your job. Your job is to have the same approach over a large enough sample size so that when you come back to review that sample size, you'll finish in a profit. So just because your stop loss gets hit, don't get upset with yourself, doesn't mean you did something wrong. Because again, where we've been conditioned in society, we've been taught that losing's bad. You know, maybe even before in our life, we've had negative consequences for failing a test or losing or doing something wrong. And in the market, especially, you lose money, so you think you're doing something wrong. But for you, the metric you should start judging yourself on is, did I follow my rules? So if I lose a trade and I know I followed my rules because my mentor reviewed it and he told me this was a great setup, doesn't mean it's a bad setup because it lost. It means that I followed my plan and my loss was actually stopped. Don't get mad when your stop loss gets hit, because if you said that I'm losing $1,000 on this trade or I'm losing $100 on this trade, if it triggers, good, it stopped your loss, right? Maybe some of you need to get your stop loss gapped by 30 or 40 pips before you can start to appreciate that loss. And your take profit, don't get excited because you won a trade, because sometimes you can win a trade literally just from luck. If the trade wins, doesn't matter. If the trade loses, it doesn't matter. What matters is if you followed your plan and kept the same repeatable approach. And if you've got a plan that's actually validated and backed by data, you've had your chart work reviewed by a mentor who's someone who's more experienced than you and has the results you want, and they tell you what you're doing is correct. You look at your journal and you tell yourself that you are following your plan over time because the trades are telling you that, you will start to finish in profit. If you're still finding yourself losing at that point where all of your charts have been validated by a mentor, you are trading a system that's proven by data, not just some random YouTube video concepts, and three, you've been doing this for a long enough period of time, you will become profitable. If you're not, it's one of those three things. It's either one, you're applying the concept correctly, two, your strategy's incomplete, or three, you haven't given yourself enough time to actually experience the system. You see, when I work with my students, I take them through this exact same blueprint because successful trading is an exact science. It's not guesswork, it's not luck, it's a science. The right approach always leads to the right results. Where what we do, the first thing we always do is teach them the system and look at their markups to see, in theory, if what they're doing is actually correct and they are applying it correctly. At that point, they now start to trade and we now check what is their efficiency rate. Because in a backtesting environment, of course, there's no emotions. Efficiency rate just means how well do you follow your plan. So if, for example, a trader is now trading in the markets on a demo or live account, we don't look at their profit and loss, we look at their efficiency rate. Because if we're finding they're taking 10 trades but breaking their rules more than 10% of the time, it's impossible for them to become profitable because now their approach isn't consistent. So what we start to look for after we've validated their technicals are correct is if their psychology is influencing them. And we know if their psychology is influencing them simply because they're breaking their rules. And once we realize, okay, cool, the technicals are fine because we validated it. We can check their markups and it's great. But obviously now they're breaking their rules. Now we'll work on their psychology. And at that point, there's no error with the technicals, there's no error with the fundamentals, there's no error with their psychology. At that point now, when it's been validated, the only thing left is just time. And time just means TIME, things I must experience. So if you can validate that, yes, I've got a good mentor who's looking at my chart work. He's told me that all of my application is correct. My efficiency rate is high and I'm following my rules. It's now just a case of looking at your data and starting to build the commonalities. If you've taken 20 trades, what's the commonality between all of your wins? What's the commonality between all of your losses? You know, if you're finding that, for me, I would find that I would always lose during Asia session. So what did I do? I stopped trading Asia session. And guess what? My win rate started to increase. But I could only start journaling my trades and collect and use my data to change my plan once I had all the other steps validated. So if you want to get all of your steps validated, go down to the description and apply for the Master Required Mentorship Program, where we'll see if this is a good fit for your situation. And if so, we'll take your trading to the next level. I hope you guys did enjoy this video. If you do have any questions or anything you want to see next, go down to the comments, let me know. And you already know I'm going to see you at the top, from the top, because that bottom is way too crowded. Sheesh.